First, I want to say hello to everybody. I want to welcome you. There's a lot of new members in this group. Awesome, got the thumbs up, so that means you can hear me. And I want to say I'm really excited to do this training with you today. Thank you so much to everybody that responded. For those of you that are a little bit new here, I know you may be looking around still and wondering what this group's about and wondering what we can do for you. At the end of the day, what I want this to be is a community where you can ask questions, you can get help, and you can speak with other people that are in the same situation as you. Going into retirement. I know there's some folks here that are going to early retirement at 55. That's great. There's some folks here that would love to retire yesterday, but they're not sure if they can leave their job yet. So, we really have to try to encompass everybody's needs. So what we're going to do today is just start at the beginning, with some of this training, and just start with just helping you with the basics of where should you start? If you're talking about investing in retirement, where should you start? And so that's what I want to get into today. Okay. So hopefully you all can see this. So today we're going to talk about investing in retirement. We're going to talk about getting started and 3 big mistakes to avoid. Okay, these are mistakes that I see all the time, and we'll get into those as well. All right. So, like I said, agenda here. We're going to talk today mainly about creating your investment policy statement. Okay. If you've never heard of that, we're going to go over that. Not a problem. We'll explain exactly what it is. We'll explain the importance of it. And this is something you should be creating before you ever implement your investment portfolio or any investment decisions. Okay, then we're going to talk about as well the 3 big mistakes that investors make in retirement. Okay, if my system will allow me to switch screens here. Oh, okay, good. Okay, so what is an investment policy statement? At the end of the day, all it really is a coherent set of guidelines for managing financial assets that is in line with your goals and the realities of the investment markets. At the end of the day, it's not realistic to say you're going to get a 50 or 100% return every single year. I know many of you have probably heard of this thing called Bitcoin, and people who are getting rich quickly, but that's not the type of investment that we want to be working with in retirement. Okay, so that's what this investment policy statement is for, to describe the set of guidelines, and we're going to talk through exactly what you should have in there. Okay, so this policy, it's going to provide an overarching guidance on the implementation of your asset allocation, your portfolio management, and your investment strategy. If you've never heard of the term asset allocation before, what that means is essentially what your portfolio is going to be comprised of. So are you going to have some U.S. stocks? Are you going to have some international stocks? Are you going to have some bonds? Are you going to have some real estate? Those are all different things that would make up an asset allocation. Okay, portfolio management is how often are you going to do things like rebalancing? It's good to rebalance at least once a year, sometimes 2 times or sometimes more. If the market is turbulent, then you could be rebalancing even more often, okay? Then your investment strategy is essentially, what do you want your investments to do for you? What's the goal? What's the long-term strategy of what you would like to have for your investments, okay? So it should cover risk tolerance. This is the biggest one where I think a lot of people get hung up. Instead of really doing a deep understanding of risk tolerance, a lot of folks freak out. We're going to talk about that. But risk tolerance is essentially how much could you see your portfolio, go up or down, and still go to sleep at night feeling, relatively good. And then it should also cover having a realistic rate of return based on your risk tolerance, okay? So you can't say, oh, I can't handle any risk, but I want a 12, 15% return every single year. It doesn't quite work like that. There's always a balance between realistic rate of return and the amount of risk that you can take. And risk can be widely spread. You can be high risk, low risk, somewhere in the middle. And most folks are are in the middle, sometimes to the lower end towards retirement, but we get definitely a big wide range there. Okay, so your investment policy. So it serves as the basis for developing, administering, and reviewing an ongoing program of investments, okay? There's really no such thing as set it and forget it when it comes to your investments. You have to be monitoring these at least a few times a year. Excuse me. What I don't want you to do is be watching the market every single day, freaking out for every new news headline that comes out that's not a good way to be, administering or monitoring them either. So, but you want to be doing it on a regular basis. There's a lot of opportunities for things like, tax loss harvesting, which can actually save you money on your taxes each year, and rebalancing when it comes to different parts of your asset allocation getting out of proportion, okay? So I want you to think of your investment policy like a compass that keeps you pointed toward your higher goals and as a tool to drown out the noise and fear of the financial media. It's really a shame, how much the media just will put on hours and hours and hours of things that are set to cause you to have fear or something like that, because at the end of the day, that's what sells commercials. In reality, we've had a very, very good decade, this last decade. And as we'll talk about later, 2017 was probably one of the calmest years ever. So this year, with a little bit of turbulence, it's very normal. But if you're to watch the news every day, you would think, little chicken or, the sky's falling and Chicken Little, is running around in circles. Okay, so that's not what's happening right now. As I mentioned, 2017 was one of the calmest years for the stock market of the last 5 decades. Okay, so we have a tendency to forget about, 5, 10, 15, 20 years ago. We're seeing a lot in the housing market right now. I mean, the housing market in California, where I'm at, is absolutely crazy. But we're seeing that. So people are getting these loans that are much bigger than they can afford. They're doing zero down again. That's very common. And so these are all things you need to be aware of. But in the stock market, it was very calm last year. There were some new tax policies I'm sure we're all aware of that have been put into place that have caused a little bit of turbulence when it comes to things like the tariffs. But nothing really out of the normal has really happened this year at all, and for sure not last year. So, but a normal year in the stock market has about 50 moves of 1% or more, or about 1 per week. So, you're going to see investments go up and down 1% or more about 50 times on average per year. Okay, this is why I say not to really look at your investments every single day, because all you're going to do is cause yourself a lot of stress. Okay, when you have a good investment policy statement in place, you have a compass, you have a process, you have your goals laid out, you have your risk tolerance laid out. So when there are fluctuations in the market, you can go back and say, okay, this was expected based on our portfolio, okay? And that's what you use as your compass to make sure that you don't freak out and sell everything. Okay, so there are times when investors will lose their sense of direction. When you hear these crazy news headlines, the Dow Jones has dropped 300 points. Maybe you should be investing in stocks. Or maybe you shouldn't be investing in stocks. Or the stock market has risen 15% in the last year. Why do I have half my portfolio of bonds? I've heard that before. Shouldn't I shift more to stocks now? So in reality, when you're seeing things like the stock market going up a lot in a short amount of time, or drops, those are the times that you don't want to make irrational moves. And you definitely don't want to try to chase performance. Chasing performance is definitely losing strategy. There's a lot of fear and greed that will come in, and the natural human tendency is to, buy more when it's high and sell when it's low. We freak out, and at the end of the day, that's why most average investors that are not working with a financial professional average about 3 to 5% lower returns than somebody that does. And a big reason for that is because we help people stay in the market. We help people create the right strategy, the right risk tolerance, and that all comes in with this investment policy statement that you get when you work with a professional. Okay, so we've got to stop the freak out. We have to bring the data and not the drama, and really focus on what our overall goals are, and look at our investment returns on a long-term period. Okay, and we can talk about strategies probably in the next training, but we want to get this definitely down because it's really important. Okay, so this is exactly why you should, and what we do with clients is establish a written investment policy statement, so that when there's turbulent times come, we can go back to your IPS and remember why we are investing the way we are. Really, really important to have it written out so you can have it in your hand, print it, and reread it, because there's going to be some important things that go in there. We're going to talk about that. Okay, so the purpose of the investment policy is twofold. One, to provide a foundation of goals, time horizons, and constraints on which the portfolio is constructed. Constraints are good, which means that you don't buy or sell certain things inside your portfolio because they're hot. Again, going back to Bitcoin, okay, that's one where there was a huge push of the quote-unquote Bitcoin IRA. Came from the same company that started the gold IRA. And it's just a way to get your money that is in your hands into their hands, okay? And these type of companies are going to charge you 15% as a fee for whatever you move over. So, they want to get you in these different things. And again, part of your investment policy statement is to outline what you're going to invest in and what you're going to not invest in so that we stay aligned with those goals. Okay, and it's also to provide a basis for review, performance evaluation, and adaptation to changing conditions, okay? I can't see comments on this screen, so what I'm going to do is I want to check in with you really quick, see if there's any questions. If you have any questions, go ahead and leave a comment. If you have questions on anything we talked about so far, I'm going to pull up my phone as well because I don't know if the comments are going to pop up here. I do see the thumbs ups, but I want to make sure. Of goals, time horizons, and constraints. So if you have a comment, go ahead and drop them in there. I'll make sure to answer your questions. I have it here on the side of me, and we'll take a break every so often to jump in on that, okay? But let's get back into our training since I don't see any comments besides the questions that were left ahead of time. Okay, so I'm not sure how to say his name properly, but Heraclitus. The only thing that is constant is change, okay? When it comes to life, when it comes to investing, when it comes to your retirement, the only thing that's going to be constant is change. It's not going to be the same as it was when you started 5 years after and 10 years after and 15 years after. So we have to be prepared and look at things on different time frames when it comes to your retirement, when it's before, during, and mid, early, and late. Okay, so investment policy statement is something everybody needs to have. If you haven't done it, that's definitely something you want to get in place. But now we're going to talk about 3 big mistakes investors make in retirement, okay? Number 1 is they let fear be the dominant emotion when it comes to making decisions on what to do with their nest egg, okay? So the number 1 fear of most retirees is running out of money. It's very justified. I can completely understand that. So they're worried about running out of money. So instead of working with a qualified investment advisor that can help them deeply understand the risk, tolerance, timeline, and retirement funding needs, what I see as a big mistake is they're putting way too much money in an insurance product like an annuity, okay? Annuities have their place. There's nothing necessarily wrong with them as a product themselves, but you should not have all of your money in an annuity. Even half of your money in an annuity is too much. A portion of it, okay. But the traditional type of annuities that I'm seeing all the time are like these equity index annuities, these fixed index annuities. Those are not the type you want. They're extremely confusing. They're extremely misleading with the way that they're sold, and the fees in them are very, very high. And so what you're supposed to be getting as a return typically is not happening, okay? So what I see a lot is people are guaranteed, say, 2 or 3%, but then there's like 1 or even 2% in fees. So essentially, you're not getting any return on your money. And then on top of that, they call that index, it's called indexed annuity, that you're going to get the return of some sort of index, okay? So they say, I've seen the S&P 500, that happens a lot. So they say, okay, well, your money won't go to 0, but the most it can go is 50% of what the S&P 500 returns, up to 6%. So there's all these little tricks in there. And then on top of that, you actually I would say 90+% of the time, you do not get to participate in the dividends of the companies in, say, the S&P 500. And the dividends are a huge portion of the S&P 500 returns over a long period of time. So when you think you're going to get, 3, 4, 5, 6%, if the market's doing 7 or 8%, a lot of times you're going to get 2 or 3, and then you have your fees that come out. So what does that leave you with, 1 or 2%? So there's a lot of things that are in there that you really want to watch out for, okay? Annuities are not one of my favorite products at all, but they do have their place. So there are one type of annuity that we talk about today that I do like, and that's called the single premium immediate annuity, and you would only buy that right at retirement. Essentially, you take a portion of your assets, you put it in there, you take the actual payment immediately, and you know exactly what you're going to get for the rest of your life. A lot of people are putting money in their annuities 10 years before they retire, and so not only are they constraining that money to grow over the 10 years before retirement, but also if they need it, there's probably going to be a big time surrender fee of a lot of times 10%. So here's an example. I had a client that had an annuity, and it was $300,000 that she had put in, that she had rolled out of her 401k and into this annuity while she was still working. Okay, given her risk tolerance was on the low side, so that's fair enough. But when we actually did her income needs, because she wanted to retire, because she came to me about 90 days before retirement, which is usually not the best, right? You want to come as early as possible, but you know, it is what it is. A lot of people come 3 months, 4 months before they want to retire and make sure everything's good. What we found out is, if she were to take that annuity payment, not only would she not have enough to cover her basic expenses, but also when you have an annuity, you give up full control of all of that money, okay? So her $300,000 would have been gone, and she would have had a payment that equated to about 3% of how much money she put in there. And that was after leaving this money in there for about 7 or 8 years, okay? So in this case, what we decided to do was to actually move that money out of the annuity. She did have to pay a small penalty because she had a few years left, but it wasn't the full 10%. But it was about $15,000, right? So what you have to look at in that case is, well, what's it going to take you to make that money back? And we did all the calculations based on risk tolerance, and it's about 2 years for her to get back to where she was. But then not only would she be able to have a larger payment, which would allow her to retire, but she also had full control of that $300,000 to either use for emergencies, medical expenses, or to give to her heirs if she didn't actually use it, which based on our calculations, she would not run out of money if she stayed within that range. But she definitely would not be able to have retired if she would have taken that annuity, okay? So really something to think about. If you have questions about annuities, please reach out. I'll help you out with that. Okay, mistake number 2. This is a huge one, especially for, maybe some folks have been investing for a while, or the ones that work with, very large companies. They're overpaying for investment expenses. Okay, back in the 70s and 80s, most funds, if you're going to actually invest in mutual funds, for example, they had upfront commissions of somewhere between 5 to 8%. So you're going to pay 5 to 8% upfront of your money when you put it in, and then you're going to pay an ongoing fee of 1+%. Okay, so in this case, if you had these funds here and they were evenly spread out, you would have an average fee of 1.28%. But that's just for your investment expenses. Okay, that does not include any other management fees or any other fees that the companies may charge. So there are, let me go back one. There are other fees like 12B1 fees that are hidden. So they're hidden deep in the paperwork, and those can be, usually between 0.25 and 0.75%. Plus, there could be other front and rear or ongoing loads that you will be paying that comes out of your returns. Again, these things are hidden. They're not easily found. And really, you have to be professional to dig through all the paperwork. And it's just crazy, some of the stuff that I see when I'm actually getting portfolios from folks that were working with certain very large, very popular names. I'm not going to call anybody out, but I'm going to show you this here, okay? So here are the average expenses of the large companies that you've probably heard of. There's a very good chance that you've heard of many of these companies. So, Ameriprise, there's probably one on every corner. UBS, Morgan Stanley, Wells Fargo, who's in the news right now. Wells Fargo is in a lot of trouble for all the things that they're doing for the 401k. So if you have a 401k with Wells Fargo, definitely reach out, because right now there's a big lawsuit coming up regarding that, and you could probably get some money back. Merrill Lynch and JP Morgan. But if you look at these fees here, the advisory fees at Ameriprise, this is the average, okay? 1.75 to 3%. Then it's saying the average fund fee is 0.5. I think that's low. I mean, that's just the average of all of them, so that's, everything that they have. So they do have lower price options, but most folks I'm seeing are about 1.25, okay? So this is on the low side for your total fee, 2.25 to 3.5%. So let's say you're in a conservative portfolio and you expect it to get somewhere between 3 to 7% per year on average. What's going to happen if you need to draw off, say, 3 or 4% for you to live off of, and you have a fee of around 3%? Essentially, what's going to happen is your money's not going to keep up with inflation. So what's going to happen? The value of your retirement fund is going to go down year after year, and you're going to have less and less money that you can spend. So these are the average total estimated fees at these large firms. And I really think these are low. I've never seen a portfolio coming from one of these companies that actually has average fund fees that are this low. Usually I'm seeing about 2% of a upfront commission, and then ongoing about 1.5, 1.3. Okay, so you can add another percent to these. So it might be about 4%, 4% here, 3.5%. That's very, very common. Okay, and if you need help looking through those, let me know. I'll help you figure out what your fees are. So, and this is typically only for investment management or very basic financial planning. Here's one thing that I know. Basic financial planning is not the right answer for most people. It's good, I would say, for young people because so much is going to change over the next 30 or 40 years. So you just need to have something to get you on track. But for most folks, when they're going into retirement, there's a lot of things that they need solved. And that includes maximizing Social Security, Medicare, there's a lot of other things I'm going to show you in a minute. But that's typically all that fee is going to cover is basic financial planning. So maybe a couple calculations and some basic advice on college or something like that. It's usually not very good. And let me contrast this with, say, what my firm would charge on average for investment management. So my portfolio fees, instead of 1.5 to 3%, usually we're about 0.1 to 0.3. So that's 10 times less expensive than these firms, okay? That's because we use highly efficient index funds and ETFs so that money goes back to you, okay? And management fees are about 0.65 to 0.95, and we have a technology fee of 0.2%. Pretty simple. You can be all in and still be less than about 1% all in. So that's about 33% of what you'd be paying at a large firm, okay? And I'm not the only one out there. I'm not saying you have to come to me. I'm just trying to educate you on what is available so that you know and you can be a smart consumer when it comes to getting help with your retirement investments, okay? So really, really, really please get a second opinion if you're working with a large company. I know you trust the brand name, but what you're getting charged is probably not good for the value. Okay, and then here's mistake number 3. They try to do it all on their own. To be honest, I don't really understand how folks get through this retirement transition without any assistance. There's a lot that goes into it. There's a lot of different factors that you have to consider. When to take Social Security, what type of Medicare plan, how to manage your investments. Maybe you have a pension that you need to decide whether to take or whether to roll over. Maybe you have bought things like whole life insurance or annuities that you need to really analyze to figure out when the best time is to take them. And then not only that, they have multiple ways that you can take them when it comes to things like annuities. There's a lot that goes into it. And then there's, the lifestyle goals, like making sure you can fund the things that you want to do that are enjoyable in retirement. And then you have legacy goals, like figuring out how you're going to keep the government's hands off of your assets as they transfer through to your kids or grandkids. Quick example, in California, right now, the average time it takes to go through probate, which is the court process you have to go through if you don't have, your wills and trusts in place, is 8 months to a year. So if you were to pass away today in California without your estate planning documents in place, it would take 8 months to a year. And say if you own a house here in California, average houses are probably $600,000. It's going to cost you about $30,000 in fees just to go through that process and all that time. And whoever's taking care of your estate has to actually manage everything and make sure it gets paid. There's just a lot of mess that goes into it. So that's mistake number 3, is trying to do it all on their own. Here's some things that you need to think about as you're going through this transition into retirement. Most people think that financial planners or financial advisors only offer advice on investments or insurance. While it's true for the majority of people call themselves financial advisors, there's so much more to getting your retirement plan right. So you want to get involved with somebody that can do comprehensive financial planning, okay? That's what we do. These are some examples of services and things that we help folks out with beyond investment management and making sure insurance is in place. Social Security timing. On that one recently, I saw a $270,000 difference by timing it correctly between husband and wife on who takes their draw and at what age. And by doing that, and even taking money out of your retirement assets, a lot of times the return can come back to you in just a few years. Okay, so that's a really big decision. Medicare plan selection. That's easily a $3,000 or $4,000 decision per year if you get that wrong, because you pick the wrong Medicare, or excuse me, Medigap plan, or you don't get the right drug plan, or you don't do things on time, so that you have to pay fees for years after you made that mistake. That's a big one. Estate and tax planning. Tax planning is a huge one. When it comes to, let's say you have different types of accounts. Let's say you have annuities, and you have your 401k, and you have your Roth IRAs, and you have a taxable account. Well, you want to make sure you're taking your investments out in the right order so that you pay the least amount of taxes. It's very easy to lose out on tens of thousands, if not hundreds of thousands, on taxes because you do things out of the right order. So those are things you got to think about. Pension decisions. Some pensions are good. Some pensions are very risky. There's cities that are going bankrupt. California, they're stressing out right now about the pensions that they're going to have to cover for these teachers, and they're reducing benefits at this point because it's called CalPERS. The program was completely underestimated what they were going to get returns for when they put things in place and they raised benefits. Then there's business planning. Maybe you need to either sell a business or you want to start a business in retirement to earn extra income. There's definitely some things that we can help out with there. Creating additional income streams. So there can be income streams from investments. There could be income streams. Maybe you do a reverse mortgage. Not always recommended, but sometimes it can be good. And again, starting businesses or doing things online that can bring you an additional income. Roth conversions. That's a huge one. If you've never heard of Roth conversions, Google that. That's massive, massive value can be tax-free income that can reduce your required minimum distributions at 70.5 that you have to take out. And they can also lower your taxes for things like Social Security and lower your Medicare costs, because Roth accounts do not count towards your taxable income. So if you get those conversions going before you turn 70.5 and take care of the taxes early on, that's a really smart move when it comes to retirement planning. Okay. And then business and encore career planning. All right. So those are some overall big categories. There's a lot of little micro details that go into these things, but doing it alone, I think, is just a really, it's not a smart move. I would definitely recommend investing in yourself to get your retirement plan right, because it will make your life so much easier. It brings a lot of peace to you, and if you know what you need to do step by step, transitioning from working to retirement, or if you're in retirement, to make sure that your money lasts the whole time, is you really want to get some help with that. Okay, so that's all I have for you today. If you have any questions, if you need help, if anything we talked about today struck a nerve with you and you want to get some additional feedback on your current situation, this is my scheduling link. So if you want to go here to jasonjhamilton.com/hello, you can actually schedule a time with me, whatever time works for you. That's in there for you to use anytime. And just as a reminder, we do all the services that I just talked to you about. We'll walk you through step by step through your whole retirement game plan, and we'll meet you where you're at. Okay, there's no investment minimums, nothing like that. A lot of folks, to get full comprehensive services, a lot of firms are required to have $500,000 or $1 million. If you do, great, we can help you out. But if you don't, that's okay too. We're able to bill and just charge a fee for services like you pay a lawyer or a CPA. We do not sell products, do not sell insurance, but I do have insurance team that will make recommendations for you if you are looking to get an annuity. So if you're looking for an annuity or any sort of long-term care or any other insurance plan, those are things that I can help you out with. And then I'll get you with somebody that does not work on commission, and that will get you the plans that you can get the same things you get all in the open market, but we'll get them for you with next to zero commissions. Okay, so those are all things that we can help you out with, getting everything in place. If you need help, please reach out. Don't hesitate. And I should mention to you that this is a complimentary session, okay? So there'll be no cost for this, but the only cost is going to be is if you don't schedule time, the risk you're taking about getting it wrong later, okay? So these are 45-minute sessions to an hour. I'll work with you. I'll help you figure out a high-level game plan. And then if you want to go do it on your own, that's great. But if you want my help, then we can discuss what that would look like. And if it's a good match, then I'll tell you exactly what it would be for the next steps. But go to jasonjhamilton.com/hello, and I will be happy to speak with you and schedule time with you, okay? Once again, if you need anything, leave a comment here. If you didn't watch this live, go ahead and drop a comment down below with your questions, and I'll do my best to answer them later. I know this was an odd time for a lot of people if you're still working, but it's just the time I had today. I have a lot going on, and I wanted to do this today. I didn't want to delay till next week, okay? So once again, my name is Jason J. Hamilton. I'm the founder of Keep It Simple Financial Planning, and I look forward to speaking with you soon. All right, you guys have a great afternoon, okay? Talk soon. Leave me a message down below if you need anything, all right? Bye-bye.